Hello, I'm a 21-year-old investor looking to compound my wealth in the stock market. So in today's video, I'll be covering 4 different stocks to buy in this overvalued market today. So this is my portfolio. I made some changes along the way. I'll be covering it in today's video as well. And the first stock that I'll be talking about is actually Visa. So Visa is only up around 5% year to date. It is underperforming the S&P 500. And for Visa, they just released their earnings a few weeks ago. The earnings were quite good. So net revenue was up around 11%. So Visa has many different revenue streams over here. Let me break it down. So first of all is services revenue. Service revenue is dependent on your transaction volume. Because services revenue is basically the transaction fees that they collect when someone passes through their Visa network. And then you have data processing revenue here. Data processing revenue is dependent on the number of transactions made. So it is the revenue that they make from authorizing the transaction. And then you have international transaction revenue, which is your cross-border transfers. And then other revenues is your value-added services that they provide. Last one is your client incentive, what they pay to the banks to try and get them onto the Visa card. So most of it is tied to your consumer behavior as well as transaction volume. And it's been positive for many years already. And it will continue doing so. I mean, even during COVID, when the whole world was in a lockdown, Visa's revenue only dropped around 8% in that year. So for Visa, the reason why the stock is down today is because of your AI trade. So everyone is chasing the AI stock. They're neglecting a compounding machine like Visa, which is currently trading at a decent valuation. And besides that, Trump loves stimulus checks. So in his first term as president, he also introduced a lot of different stimulus. And he introduced tax cuts as well, which is what he's doing in his current second term. So what this will lead to is consumer spending. It stimulates the economy, and Visa being the toll gates of consumer spending will stand to benefit from this. And currently now, Visa is trading at a decent valuation. So on a normalized PE ratio basis, the company is currently trading at around a 28.5 times price to earnings. And historically, this is on the lower side as well. In 2022, it traded up all the way to around a 28 times earnings before falling to the trough of around 26 times of earnings. So if you were to do a valuation like this for Visa, assuming an EPS growth of around 13%, so that is made up of 2% of buybacks as well as 10 to 11% of net income growth, and assuming the PE ratio holds stable at around a 28 times of earnings, Visa today will give you returns of around 13% over the next 5 years, which I view as decently attractive in today's market. The next stock that I'll be covering is actually Amazon. So Amazon is up around 4% year to date. It was at all-time highs at around $258 a share just a few weeks ago, and currently it has erased its entire post-earnings move. So for Amazon, I mean, you have this picture here. So why exactly am I showing you this? So for Amazon, besides the network effects mode that they have, which everyone knows about, the flywheel effect where more people leads to more buyers, which leads to more sellers and so on. They also have all the different fulfillment centers as well as logistics centers all around the US as well as in Latin America. So for Amazon, the moat for the company besides the network effects is actually your fulfillment centers. So in 2022, the company spent a lot of capex trying to build out all the centers. So think about it in Singapore, for example. Let's say if Shopee here has 20 fulfillment centers in the entire Singapore, then it doesn't make sense for any competitor to come into the space because you can't beat Shopee as well as the proximity to all the different consumers. So this is what Amazon has done as well. They built so many different fulfillment centers that the startup cost for a company to come in and compete is almost impossible, which is why Amazon today has one of the largest scales in terms of your e-com sales in the US itself. This is another moat for Amazon as well, which is not really talked about. And besides that, Amazon has also a thesis which is coming up next year. So Amazon Prime is going to increase prices next year following this trend. So in 2014, they increased prices. In 2018, they increased prices. In 2022, they increased prices as well. So assuming this 4-year trend holds, they will probably increase prices next year. So this is something that the markets are probably not pricing in yet, given the analyst estimates. And currently, Amazon's ad division is also doing extremely well. For Amazon, if you were to think about it, the Amazon store is actually a funnel to the advertising business. And advertising is one of the higher margin profile business that you can operate in. And currently, Amazon is growing at around a 23% CAGR over the past 5 years in terms of its ad division. So it's growing a lot faster than Google, like Meta. So I view this as a lever that the company can keep pulling over the next few years as it funnels more people towards its ad division. Next stock that I'll be covering is actually Booking Holdings. This stock is up around 2% year to date, underperforming the S&P 500. So for Booking, the reason why the stock is down is because people are fearful that AI will disrupt Booking's mode. So people are fearful that AI agents will come up with plans, come up with travel itineraries, which will displace Booking's entire network. I think this is the reason why the stock is down, along with all your different other software companies this year. So for Booking, this is one of the modes of the company, the network. So Booking has contracts as well as contacts with many different hospitality places like hotels in Europe. So this is something that is extremely difficult for any AI company to try and displace, because it is years and years of building a vast network that cannot be displaced so quickly. And for Booking, the business will not be disrupted by AI overnight, could come over time. And besides that, this is Booking's mode, of course, is the flywheel effect again. So more hotels on Booking leads to more suppliers, which leads to more customers, which leads to more demand. And besides that, Booking's current traffic is actually 60% direct to the site. So what that means is Booking already has a loyal client base, which is searching directly for the Booking.com site. So what this means is even if an AI company is able to develop something else, if Booking is able to hold this 60 to 65% direct to traffic volume, then there really isn't anything much for the company to lose. They also have around 15% that's coming in from social media, only around 10 to 15% is from Google search. For Booking as well as all your different travel companies, there's a strong secular growth trend in the industry. So your air transport is projected to grow at around 7% all the way until 2029. And this is overall bullish for a company like Booking. So air travel is something that is secular, it's predictable growth, and it is forecasted globally that it will be around 1.5 times GDP growth across the board. So this is almost a 7% guaranteed growth for Booking if they can hold their market share. And besides that, they have earnings yield of around 5%. So add the 7% to around 5%, that is around a 12% growth for the company already. And at its current PE ratio, normalized of course, at around the 22 times of earnings, the stock is looking attractive today. Last company that I'll be covering is actually NVR. This is a home builder in the US. And let me bring you to a Substack article that we recently posted as well on our site. So this is a short write-up on NVR. So over here it says, with interest rates and 50-year mortgages on the horizon, coupled with a large backlog in single-family homes, home builders such as D.R. Horton as well as NVR are becoming more interesting as the stock prices are plummeting on weak earnings and general negative sentiment. So a lot of your different home builder companies are falling because your interest rates have gone up in the past 2 years. When borrowing costs are high, what happens is your housing builds will start to go down because demand for your houses will go down. So over here, it's a brief overview as well. It says, in the past, the home building industry was extremely capital intensive, with companies purchasing land and then buying and then building on the land before selling the house to the public. However, the business model has changed completely to follow a pioneer in the industry. So what NVR does is they operate in an option model. So they buy the option to the land rather than owning the land itself. So they pay an option premium, and this gives them the option to decide whether or not to build the house and to secure a customer first before they build the house. So this is an extremely predictable way for them to secure revenue. And over here it says NVR has close to zero risk of bankruptcy, as all the company had to do was to sacrifice the premiums that it has to pay for the land. This asset-light business model enabled NVR to remain profitable even during the 2008 financial crisis, while others were deep in the red. So besides that, NVR is also buying back a lot of shares. So the management is a uber cannibal, and NVR since inception has reduced its share count by a whopping 85%. So if you don't know what another company does, which is AutoZone, they buy back a lot of shares. The entire thesis for the company is share buybacks driven. So for NVR, they're operating by a similar model. So to conclude, over here it says, looking into recent moves by Berkshire into home builders like Lennar as well as D.R. Horton, we can see that Berkshire is seeing a potential recovery in the housing sector, likely driven by a lower cost of debt. Berkshire is also investing into Pool Corp, the largest pool builder, pool products distributor in the US. This move signals a potential recovery in the sector that were heavily impacted by the sharp rate hikes in 2022. Berkshire's 13F's filings will be released soon, and yes, they added into Lennar as well. So the thesis of your interest rates coming down is something that Berkshire is betting on as well. I hope you guys have found this video useful and invest safe.